This is Dr. Dennis B. Anderson, and this is the fourth video about the book I wrote, Trading E-mini Stock Index Futures, A New Path to Wealth. The first video is an introduction to E-minis and how to trade them. The second video describes how to trade a trending market. And the third focuses on how to profitably trade a flat or slightly volatile market. This video is about my third model, buy low, sell high, buy lower, sell higher. When I wrote this book, I was evaluating and challenging some of the standard beliefs in the investment world. One of those beliefs is that you can't make money in a dull or flat market. When trading E-mini stock index futures, I have demonstrated that that belief is incorrect if you carefully follow my second model, enjoy those index bites. It has worked well for me during the past 5 years, as I have made several $100,000 following that second model. Another myth is that you can't time the market. That is exactly what I do with all three models. In fact, effectively timing the market is core to success in this type of trading. The set of indicators I use, along with candlestick reversal signals, allow you to trade along with what the traders are doing. Following the news and government reports is also very important. A third myth is that you can't possibly make money when there is a severe market correction. Wrong again. Using my third model, I am prepared for a serious correction of 30% to 50%, assuming there isn't a major catastrophe such as World War III, of course. The latest severe correction was the housing crisis of 2007 and 2008. Most stock indexes were down 40% to 50%. That always hurts, but can also be an opportunity, provided there is a reasonable expectation that the market will recover over time. Remember, when trading stocks, you have to have the belief that eventually prices will recover and move higher. That pattern has repeated itself every several years for many decades. Stocks move lower faster and more forcefully than they rise in price. This presents a golden opportunity to sell short these E-mini indexes and profit from this decline. I wrote in the book that I noticed stock markets falling when the outcome of the Brexit vote in Great Britain became increasingly in doubt. I shorted several contracts, and 2 days later the Dow was down over 600 points. My indicators supported the notion that the downturn was probably over, so I covered my shorts, taking my profits for that, and bought several long contracts. About 4 days later, I sold the long positions for about a $25,000 profit on this downturn and recovery. The third model cannot be adequately summarized in a short video, and it includes several pages of charts and calculations. The basics of the model are to short an index when the news traders and indicators support such action, and begin buying whenever the indicators show that the market has bottomed and is turning around. During the decline, you also have specific entry points for buying depending on how far and how fast the market has dropped. You will need to read the chapter on this model to understand the variables and your response to what the market is doing. This model also has the option to trade two indexes, providing you have adequate resources, shorting one index while entering long positions on a second index. That way, your assets stay fairly neutral and you are positioning yourself to make great profits when the market recovers. You can make well over $100,000 if the market corrects at least 40% or more. This helps make up for losses you might have in other long-term investments. In a falling market, after you enter a short position, price will likely continue to drop. After the price moves a few points below your short price, enter a buy stop a couple of points below your short buy point. That way, if the market should suddenly turn around and move higher, your buy stop might be tripped, but you will have guaranteed yourself a profit of several $100s. The market hasn't had a major correction for about 10 years, so I can't show you an E-mini chart that represents this situation. I'm going to switch over to this. As you see, I'm going to change this as well. Hold on a second. Put a cross in here. We go back to July 10th or so. Let's talk briefly about the candlesticks and the other averages, because there might be some of you who don't understand how all this goes. The candlestick body, where you have a closed end at the top and a closed end at the bottom, represent where the candle opened and closed, what price it was that day. If it's a green candle, it opened at the bottom and closed at the top. If it's a red candle, it opened at the top and closed at the bottom. Then you have a wick on the top, which shows how high the price went that particular day. And then on most of the candles, you'll also have a tail, which shows how low the price went that day before it came back up and closed. The trend from October, well, let's back up here to July 15th or so. On July 9th, that's here. Let's start with this place. I want to describe what you're looking at. You can color these lines any way you want. The green is a 50 period. Since we're on days, I'm going to call this a daily chart, 50-day period. It can be 51 hours or 50 15-minute periods. The orange line is a 20-day moving average. The two important ones, the blue line that's highlighted here is the 9-day exponential moving average. A simple average is you add up 10 scores and you divide by 10, and that's your average. On an exponential moving average, the weight assigned to a score increases more and more as you get to the end of the period. So on a 9-day exponential, you're covering 9 daily prices, but the influence grows as you get toward the end of the later days, 6, 7, 8, and 9. The pink line is the 3-day exponential, same principle. The 3-day, of course, talks about the last 3 days. The 9 talks about the last 9 days. In an advancing market where you have good momentum, the 3 will be, the pink line in this case, will be above the 9 because the shorter term is moving higher, faster than the longer term average. And you can see on this picture, I'm on July 12th, the 3x, I'm going to call exponential 3x, 9x. The 3x has crossed over the 9x here and has started to move higher at a faster pace. You also have this candlestick is called a positive hammer. It happens in the lower end of the range in this case. It was preceded by a kind of fat spinning top, which is indecision. And when you see this hammer, that means the sellers drove the price down, in this case to about 1732, but then it recovered. The buyer stepped in and moved it back up all the way to 1747. In this position, if it opens higher the next day and the 3x is running higher than the 9, you'll buy. And so here we have it. It's on the 20, which is sometimes an important average for traders, and it starts to move higher. So about at this point, on around 1748 or so, you would go long one position. As long as the candlesticks don't close below the 9x and don't open lower after that close the next day or the next time period, you stay in the trade. So here you are getting in at 1748, and then it runs and runs. The 3 is still high. We haven't closed below the 9. We still have good momentum. And you get up here and you're at 1792, or let's call it 1788, that's at least 40 points of profit. At $100 a point, that's $4,000 in about 2 weeks. Now here, when you bought, you look at your stochastics, which I talk about a little bit in video 3. They're in a neutral position. Now as the market runs, the stochastics move higher. Now look where we are here on July 25th. That's the time the market has peaked up here, as it turns out. And you don't need to see what happens the next day to figure that this might be a time to take your profits. If you've got $4,000 in about 10 days or so, take it. Don't get greedy. And sure enough, the next day, we've topped out. The buyers are washed out. Everybody's going to buy who's bought for the time being. And the next day, the sellers step in and start shorting the market. And here we're going down now. The same principle applies. Here on this candle, the 3x moves below the 9x. And it's a gap lower here this day, about 2 or 3 points, and it starts moving down. You short right here at about 1770 or so. Now you're at the opposite position. The 3 is running under the 9, showing greater downward momentum on the short term. So you stay in a position until a candlestick closes above the 9x, and it opens higher the next day, and the 3x crosses under the 9x. Until those things happen, you stay in the trade. This isn't nuclear science. So here it moves down. So you shorted here. Well, you could short up here, but let's take the conservative route. Let's say you didn't short till it got down here at 1270. So now look, it stays down. Here's the 9x. It hasn't gotten above it. It stays down. It runs all the way down here to 1703. That's somewhere around 70 points, depending how you want to calculate your short position up here. But that's another $70,000 and another $7,000 in another 10 days. Now look at when you're down here now, looking for confirmation that it might be oversold. Go down to your stochastics. Look at here. Both the slow and the fast stochastic are under 20, suggesting support for the notion it might be oversold. I would close my short position right here at the close, or the next day when you see it starts to open higher, I would close it then for sure. Now, conservatively, you stay out of this trade, but if once you get understanding how this goes, it'd be okay to enter a long position here around 1706 or so and put a stop underneath it so you don't have much of a loss. It's going to go up, and you could put your stop at about 17.8 or something, guaranteeing yourself about $500 profit, even if you get stopped out. But here you can buy if you want, and then it runs up, and it doesn't break the high. So if you get up in this area and the red candle forms, you start to go down again, take your profits. You will have made, I don't know, somewhere around $2,500 in 2 or 3 days. I might trade this, but if you're beginning, I would stay away and stay with the ones that definitely are well within the system. The 3X is still underneath, showing a negative trend in the market, although it did come back up here a little bit. And once again, now we're still negative. Here it got up, it opened here over the 9, but then it started down and it fell some more. Now look where we are. We're back down. Let's assume we have not traded any of this last 5 days. It's kind of dicey. It isn't sure what's happening, and that'd be a perfectly reasonable thing to do. But now we've washed out. We're at a new low down here. And look where our stochastic is, under 20 once again, oversold. We have 2 dojis here. It closed at this price, it opened and closed at the same price, it opened and closed this day on the 21st at the same price, and it opened here at the same price. When you have 2 dojis like this and you're in the oversold position and the market moves higher that next day, it's appropriate to buy because the indecision, the sellers washed out here. You had two of these big down spikes, and then you had 2 days of indecision. And now maybe the news has gotten more positive. That's why I have to listen to that. But then here it starts back up again, and it'd be fine to go long here because you probably won't be wrong. Let's call this 1695. Now let's see what happens. Well, here we go. Now you go up here. You still haven't crossed, your three hasn't crossed above, but you're in a positive momentum. You see the stochastic moving up down here with you. That's positive. So you stay with that. Now here you get a hammer, but it was a down trend, but then a pullback. Now here you're above, you close above the line, above the 3X above the 9, and you start higher here on the 31st. Stay with it. You're in the positive territory now. It goes up here, goes up here. Now you have a decision to make on this day. This is, where are we here? 1738 or something like that. And you've got a gain here of about 45 points over 8 days. That's $4,500. The buyers have been pushing this high with pretty good momentum. I would take my profits up in here somewhere around 1735. Don't get greedy. You made $4,500 in 5 days. That's $900 a day just watching the market do its thing. So get out. And that's a reason enough. It pushes a little higher up here, but it's going to, you backfill. You have a run up and then you consolidate a little bit. Here's a doji, another one, kind of a fat doji, spinning top maybe. Now here's another positive hammer as you reach a temporary bottom here, and you've got the 20 moving average here, simple moving average. Also, when I suggested you get out up here, notice where the slow stochastic is. You're over 80. If you have any doubt about whether to be greedy or not, this confirms the acceptance of the notion of getting out. So now here we are again. Now it's September 11th, and the 3X has gone under the 9X. Well, actually didn't ever go lower. It got right on it. And you've got a good push here. I would buy somewhere in here around 1725. The lines are aligned here, and we got a good movement on this daily chart. So you get in here, now look what happens. Here we go again. I mentioned this in the other video. Now we're running. The candlesticks don't touch the 9X line. They stay above it. They don't close below it. Well, they kind of touch it, but the important thing is, do they close? It's not always where the tail and wick are. It's where it closes. So here we keep running. I talked about this in the last video, and it goes up here. This is a run of about 95 points, and it's I think about 16 days here. And then I talked about here how you then can, once we top out and start to consolidate some more with low volatility, that's when you can go back to Model 2 and use the index bites. But this will be Model 1, trading these trends that you see over this daily chart. So you made, over 3 months here, just trading the ones I highlighted, you made about $30,000 in 3 months, trading only one contract, $10,000 a month, one contract. And if you throw in maybe trading some index bites up here, you maybe made another $5,000, or you could. So now you could have $35,000 in a little over 3 months. That's not too bad. As you can see, it's not all that complicated. So as I say, as long as those positive conditions continue to stay in the trade, when you get the indicators that indicate a candle reversal signal, alert you to take your profits. You may then soon have an opportunity to short the index. The thing is, you can't beat the professional traders, but you can trade with them, getting in when they start buying and getting out before they start selling. This is important. Knowing what other traders are thinking and how they are currently trading gives you a distinct and powerful advantage. If you plan to use my book to be a better trader, it is important to follow the rules exactly as I have presented them. Emotions and human nature get in the way when you decide you want to tweak these models a little, or you convince yourself that you can do better. I have maintained discipline and followed these models faithfully, as explained in the book, and have been extremely successful. You need practice and discipline to be profitable. Don't try to game the system. You will not be better off. Thank you for viewing these videos, and I wish you all the best in the future.